Today we're talking about how inflation is a tax hike. Even though you don't hear about the tax hike on the news and people don't talk about it like a tax hike, I'm going to explain here the three different ways that higher inflation leads to greater tax rates. The first one is capital gains. The second one is depreciation. And the third one is bonds. Each one of these taxes different people, that is, different segments of the economy, different people who do different things. The first two in particular, they tax businesses, including corporations and small businesses, whereas the third one taxes investors. And none of these really fall upon the wage earners. Wage earners have their own problem with inflation, but inflation is a gigantic transfer of wealth from business owners and investors, sometimes those are the same thing, to the government. I'm going to show you why. Let's start with one, capital gains. Suppose that you make a $100,000 investment. It could be in equipment. It could be to buy a business. It could be in real estate investment. It doesn't really matter. $100,000 is your cost basis of this investment. Perhaps you've bought a stock and you're hoping that this investment will appreciate in value over time. So as a consequence of running a successful business or being a successful investor, your 100K, it grows to 300K, which is a fantastic improvement. Let's give you 5 years to grow that investment. But how much of that growth was due to inflation and how much of that was due to your own business acumen? When prices in general are going up, of course, the price of your equipment or business or real estate or whatever goes up with it. When you sell this business at 300K, your capital gains tax will be computed on the basis of 300 minus your cost. That's a profit of 200K. And it sounds like you're doing really well. But over these 5 years, if inflation we're running, say, 13%, then the money that you're getting here for 300, it will only buy 150K worth of goods in year $0. What does that mean? Because prices have been going up, your investment has going up partly due to your business acumen, your hard work, your clever investment, and the value of your investment has partly been going up because of this 13% inflation. These two things get added together and they add up to your 300K, but your cost basis is not subject to inflation. Your cost basis stays right where it was in 100K in year $0. So in a low or zero inflation environment, you would have made 150 minus 100. You would have had profits of 50K. That's at zero inflation. But at 13% inflation, your profits are 200K. Which would you rather be taxed on? The 50K in a zero inflation environment or the 200 in a 13% inflation environment? Whatever you think you made as a result of your business cleverness is getting eaten up by inflation because your eventual selling price is inflated, whereas your cost basis is not. That's the first way that inflation is a tax hike. The second way is depreciation. Let's take a different example, but we're going to use the same number. At 100K, you buy a truck. And you're going to use this truck in your business. You depreciate it over 7 years. And at the end of 7 years, you're carrying it on your books at zero. Every single year, to make it easy, we can just go straight line here. every single year, 1, 2, 3, 4, 5, 6, 7, you set aside a certain amount in your depreciation account so that at the end of the 7 years, when the truck is worth nothing and it's time to replace the truck, look, you've saved 7 times 14.4. You've got your 100K cash ready to go. In a zero inflation environment, you would be ready to replace the same truck and continue your business. But in an inflationary environment, now that same truck is 300K. I know this is a heck of a truck, but you're a heck of a business person and you use expensive equipment. Although you've been depreciating at 100K and your taxes, you get a deduction for this 14.4 every single year, straight line depreciation, the real replacement cost of the truck is 300. In other words, your depreciation expense is based upon what you paid, and it stays the same for all 7 years, even though the replacement cost of the equipment is going up. Inflation does not increase the amount of money that you're allowed to deduct from your revenues for depreciation, but it does increase your replacement costs. So that's the second way that inflation acts as a tax hike. The third one is bondholders, the investors who buy government or other bonds, but in particular government bonds. You know that when you buy a bond, maybe it's a 10-year bond, you pay a lot of money up front for the bond so that you can collect interest payments on the bond every year until it matures. At 10 years, you get your principal back. In a zero inflation environment, it's very easy to calculate how much you've been paid in interest to compensate you for the risk of lending the government their money, of renting your money to the government. When you get your principal back, of course, you can buy a new bond. But in a high inflation environment, when you get your principal back, it won't purchase the same amount of goods. Each year of interest, which is constant, and your principal, which is calculated based upon what you invested, will purchase less and less because inflation is going up faster than the interest rate that you're calculating. There is one type of bond, the Treasury Inflation Protected Security, that will adjust your payments based upon inflation. But it's the only type of bond that gives you that inflation hedge. All other fixed interest bond holders are going to get screwed in a high inflation environment and wind up transferring purchasing power to the government that they weren't expecting when they made their investment. These are the three major ways in which inflation transfers wealth from business owners and investors to the government to help the government pay down those debts and keep the politicians in power.